All right, we are back for another lesson in the options trading for beginners, the ultimate in-depth guide. And now we're going to be talking about option price components like intrinsic and extrinsic value, something we talk about all the time, something that is part of my trading plan. We'll be learning more about that today. Let's go.
This next section, we are going to be talking about the components of option prices. We've already kind of talked about the real value that an option can provide the owner in certain scenarios, and depending on whether we're talking about a call option or a put option. But as we discussed and as we saw in the previous examples, particularly the IWM example, that does not fully explain where an option's price comes from. So in this section, we are taking a deep dive into option prices, and I am pretty confident that after this section, options are going to make a whole lot more sense to you. So let's dig in. There are two components that make up the whole of every option's price. The first is called intrinsic value, and the second is called extrinsic value. You don't know it yet, but you essentially already know what intrinsic value represents in an option's price. Remember when I had the house example where the house was $350,000 and I had a call option on that house with a strike price of $200,000. In that example, since my call option allows me to purchase the house for $200,000 and the house is currently $150,000 above that at $350,000, we would say that that call option in that example had $150,000 of intrinsic value.
And this intrinsic value is what we're looking to maximize. Every stock, every options chain, everybody who's ever traded options, the objective is to maximize the intrinsic value, right? You've heard these stories about Wall Street bets where somebody buys a random YOLO call in Tesla, right? And then let's say they bought something for 72 cents. Tesla rockets up to $415 from $325, right? This option just got way more valuable, right? But it still doesn't have any intrinsic value. Still doesn't have any intrinsic value. It's only once it goes into the money. So in this case, once it passes 415, that's when they're really going to start making the money. So like right here, the 215 strike has $111 of intrinsic value, 59 cents of extrinsic value. Right. This is the part that will always go to zero, the extrinsic value. The intrinsic value is how deep in the money it's gone, how worth the option is. This is worthless at expiration. This is a leveraged investment. This is where I hang out on this side of the like there's four quadrants, right? In the money calls, out of the money calls, out of the money puts, in the money puts. I hang out up in the top left corner if I'm buying calls. I hang out in the bottom right hand corner if I'm buying puts, because that is a leveraged investment, not a lottery ticket.
Meaning that the option contract was worth at least $150,000 because me, as the owner of that option, I could use that option to buy the house for $150,000 lower than the current market price of $350,000. So that is what intrinsic value is. For puts, it's the opposite. So if you have a strike price of $130 and the stock price is at $120, you have a put contract that can sell shares of stock $10 higher than the current stock price, and that has real or intrinsic value equal to $10. So since the put option can sell shares of stock $10 above the strike price, we say that the put option has $10 of intrinsic value. In the Tesla call option example, where I purchased the 800 strike call option, and Tesla shares go to $1,000 per share, since that call option has the ability to purchase shares of stock $200.
Just for context, Tesla has been split since this point. That's why Tesla call options are now in the $300-ish range versus the $800-ish range. Right? Just want to point that out in case there's any confusion with that.
Below the current stock price. In that instance, the call option has $200 of intrinsic value. And I also told you that an option's price must be worth the benefit that it can provide the owner at that moment. And what I really meant by that is that an option's price must be worth at least the amount of its intrinsic value. because the benefit that it can provide the owner at that moment, that is the minimum that the contract should be worth. So if I had that Tesla call option with a strike price of $800 and the stock price is at $1,000, since I personally could use that option to make a $200 gain on the shares if I exercise the option, but I don't want the option, I'm not going to sell it to somebody else for any less than $200. And that's because if
And that's the intrinsic value, right? That's the intrinsic value. That's the moneyness of the value that he's talking about here. And then, but he's not going to sell it for less than that. In fact, he's going to sell it for more, right? If he bought it, the price went up, there's still extrinsic value. There's still time value associated with it, but he has significantly higher intrinsic value, moneyness value to it.
if I use it myself, the benefit to me could be a $200 gain per share. So if I want to sell it to somebody else, it's going to be worth at least that amount or more when I sell it to them. So let's go to that Tesla call option example, and let's look at the image where the stock price was currently at around $836 per share. In this image, the share price of Tesla is $836.41.
Okay. Current price of Tesla, $326.09. Now, there was a question from Mikey Mike, says define split. I don't remember how much Tesla split for, but what they do is they do in this example, let's just use an example here. Tesla did a 2-for-1 split. So if it was $800 a share, a 2-for-1 split doesn't change the market cap, right? It's still the same number of shares. Oh, no. It's twice as many shares outstanding, but each share is now worth half the value. The reason they do that is because a lot of times stocks get prohibitively expensive and you can't do anything with it, right? Have you ever looked at Berkshire Hathaway stock? Berkshire Hathaway stock, BRK.A. See if I do it right here. BRK/A is $735,000 a share. Let me put this on the chart a little bit easier. BRK.A. $736,000 a share. This could be split a few times. I'm just saying, could be split a handful of times. I believe Nvidia went through a split not all that long ago. Here it's around $143. I think at one point it was pushing over $800. I forget exactly. It doesn't really matter. But the splits are now able to get more investors involved, right? So by doing that, that makes it a lot more affordable, right? Because maybe somebody couldn't buy Tesla at $800 a share, but they sure can buy it at $326 a share. So they're interested. They're interested. Let's go back.
And again, we are looking at the call option with a strike price.
Oh, here we go. Just for context here. It was 3-to-1 in 2022. Thank you, Steve and Christopher there. And then Robert said NVIDIA did a 10-for-1 split, right? The market cap didn't change. They just increased the number of shares by 10 and then divided the share price by 10. Oh, and then Rick says there is also reverse splits. There's also reverse splits. Yeah. That's to make a stock that looks like hot garbage actually look a lot better. Now, who's a snob that you know that happens to only buy stocks that are over $20 a share? Do you know any? Do you guys know any snobs who only buy stocks that are over $20 a share? The reason the stocks are under $20 a share is because nobody wants them. And to make them more attractive, they can reverse split. Right? I'm not going to buy a stock that's 14 cents. No way. That's a shitty stock. That is a terrible company. Why would I ever want to do that? But if they reverse split it and now it's $14, that's a lot more attractive of an investment than a 14-cent company. I know it sounds weird. Probably breaks a lot of brains to think, well, I mean, 14 cents in a company. Of course, I buy the mess out of it. But would you really? Would you really buy a stock that's worth 14 cents or a stock that's worth $14? I wouldn't even care about a $14 stock. If it's $140, now we're talking. Now Chris is like, wait, what is this $140 stock that we're talking about here? So yeah, thanks Rick for bringing that up as well. Yeah, the guy on the screen, that's a snob. Wait a minute, some random guy on the internet. That is such a lead in. I'm going for it. This random guy is named Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. Now, I'll get my snobbiness out of the way. We'll get back to this.
Of $800. Now, because this call option has the ability to purchase shares of stock at $800, but the current share price is $836.41. This call option has $36.41 of intrinsic value. But we can see that the option's actual price is much higher than its intrinsic value because the option's price is currently $94.10 in this image. So the portion of the Tesla call options price that is above.
Let's go back slightly. So if the share price is 836 and we're looking at the 800 strike and it's currently trading at $94, there is so much, 2/3 of this is extrinsic value. And this is in the money. That is bonkers. This is an unbelievably expensive option. Now, the way that I view options is what is the ratio of extrinsic value to the total price of the stock? Or I'm sorry, total price of the option, right? This even goes into my trading plan. I'll show you the slide. This is how I evaluate an option. I want to see 20% or less of extrinsic value. So in this case, if the stock has an option price of $94, $94.75, that's the options price, okay? And the intrinsic value is $36.41. So $94.75 minus $36.41 is $58.34 of extrinsic value. This decays to zero. Every stock, every time, every option chain, every expiration, every strike, doesn't matter, will always decay to zero. And this, I now have a prop that I keep, a quarter on my table here. This quarter will be worth more than the extrinsic value of this option on a one lot. It's $5,834 per one lot. This quarter is worth more than that at expiration. Really want to get across the point that this quarter that was manufactured in 1990, this 35-year-old quarter, isn't that crazy? This 35-year-old quarter is worth more than the extrinsic value of this call option every time, every single time. So you want to minimize that. You want to minimize this, right? Now, 5834, the extrinsic value divided by the price of the option, which is $94.75, means 61% of this is going to decay to zero. 61% of your investment will decay to zero is a shit investment. Horrible investment. This is how I evaluate if a stock, or I should say, if an option is appropriately priced. Now, my limit's 20%. Yours could be 15%. And I'll fudge it a little bit. Sometimes if it's 25%, I can live with that. If it's 10%, well, great, I'll take it. Right? So that's where I normally get to the 80 delta. And we'll talk about delta later on, I'm sure. But the delta measures the rate of change for every $1 the stock moves. How much does the option price move? Now, this is going to change on every option's expiration. Okay, so we'll just jump on this one. It's the first one that pulled up. My 80 delta is at $21.20. The extrinsic value of this, and this is why I always go to the 80 delta, because this is $2.49 divided by the price of the option, $21.20, is 11%. I can live with 11% of extrinsic value. Let's go out to 22 days out. Let's again go to the 80 delta. Let's again go to the 80 delta, which is this one here. The math always maths. This is why I go here. It's, oh, why didn't it go? 22nd. There, don't do anything else. 80 delta is here at the 305. Okay. $12 of extrinsic value, $12.31, divided by the price of the option, $33.50, 36%. So that is an expensive option. I wouldn't buy that. I think someone had a question, actually. I forget. Let me see. I didn't save it. I'm sorry. The person was talking about how they were having a hard time finding options that had 20% or less extrinsic value. Oh, actually, it changed on me. That's actually the 68 delta. Here we go. That's the 68 delta. So the 68 delta has 36% of extrinsic value. I don't know. It must have changed on me. Let's go up to the 80 delta, which is the 285. Okay. Looking at the 285, let's roll this up so it's easier to keep track. $6.74 divided by 48.25, 13.9% extrinsic value. That one I'll buy. This one I will skip. 36% will decay versus 13% will decay. Let's go to another expiration way out in time, November. Let's go to the 80 delta here, and don't jump on me again. The 260. It jumped on me, didn't it? It did. I see it jumped on me again. 245. Look at that. That's really annoying. All right. Anyway, 245 right here. What do you want to guess the extrinsic value is going to be? What do you think the extrinsic value is going to be? Probably somewhere around 20%. Let's see. $22 of extrinsic value divided by 103.60 gets you 21.13%. It's not coincidence. It is not a coincidence. This is math. The 80 delta normally puts you in the ballpark. It can be a little less, it can be a little more of the 20% extrinsic value. Now, you could go higher. You could say, I only want the 90s. You could go lower and say, I only want the 70 delta. Doesn't matter. You pick what works for your trading plan. As you know, I always want you to have the personal agency to decide what works best for you. But for me, that's my wheelhouse. That's why I hang out in this top left quadrant here, because the 20% or less extrinsic value is roughly 80 delta every time. So I don't have to be doing all the math all over the place. My eyeballs zoom right to the 80 delta. Oh, is this going to work for me? No. Let me go up a little bit. Let me go down a little bit. Let me go out a little bit. Let me go in a little bit. But I'm going to get there. Isn't that cool? Isn't that cool? So this one here, 60-something% extrinsic value, bonkers. Stay the hell away from anything that has 60% extrinsic value. Ugh.
This image. So the portion of the Tesla call options price that is above its intrinsic value of $36.41 is called extrinsic value. And extrinsic value is sometimes referred to as time value because it can be associated with the option's potential to become more valuable, particularly intrinsically valuable, before it expires.
Okay. Excellent question came from Charlotte. So the price decays with time. The extrinsic value decays with time. This is the time value, right? This is where, hey, anything can happen. Anything can happen in the markets. We know this. And even though this is at the 80 delta, there's still 20% unrealized risk here. Unrealized risk, potential risk, whatever the case is, or potential gains, if you want to think about it that way. And so there will always be an extrinsic value associated with that, that unknown risk is a better way to put it. That unknown risk goes into the extrinsic value. Now, it's going to be really high the further out you go, and it's going to be really low if we go to the one that's 2 days out. It's going to be really low, right? Because the uncertainty risk right here is, I mean, there's only 2 days. There's not much that can happen in 2 days versus 200 days, right? 200 days, we're looking at significantly higher extrinsic value. So you could think of it as time value, or you could think about it as the risk value, right? And it will always, you can't get around it. So by having a plan to work with it, rather than trying to find a way to circumvent that, you're going to be better off. This is a great question, Charlotte. Really appreciate that one, actually.
So in the case of this Tesla call option, there are over 30 days left until that option expires. But right now, in this moment, it has $36.41 of intrinsic value. But since the option's price is currently $94.10, the additional 50.
King Arthur, great point. Not always. Not always. It's a really good question, actually. It just happens to end up around there. I mean, there have been times, I just showed a moment ago, it was at 13%. There's times where it's at 30%. For me, when I'm evaluating the price of the option, it's generally in that wheelhouse, but it will also let me know if the option is fairly priced. And this is by my plan. If it's fairly priced, it's 20%. If it's overpriced, over 20%. I will go up to 25% if I'm feeling lucky. I believe it was in Palantir. I was feeling a little lucky, and it paid off huge. And then I'll go a little bit less, and that's a great deal. If the extrinsic value is less than 20%, that's a great deal. So great question there, King Arthur. Look at this. We're all learning together. If you are enjoying this, type outlier in the chat, OVTLYR. If you're enjoying this, if you're learning from it, type outlier in the chat, because I love to be able to watch these videos and give you my real world perspective on how you can make money with this. Isn't this great? Really appreciate you guys watching live, by the way.
$7.69 in the options price is extrinsic or time value. Now let's think about this. Tesla shares are incredibly volatile, and with an option that has over 30 days to expiration, there's a lot of time left for Tesla shares to move around a lot. Particularly in the case of this call option, if Tesla were to go to $900, this 800 call option would now have $100 of intrinsic value. So just
in fact, I'm going to make a change on my trading plan. Hold tight. We're going to do this together right now. And the reason being is because I feel like this lesson's really helping us talk about, I'm just going to make a little note right here, and I'll come through later and add it. We're going to insert shape. I like an arrow, and I need to do something. And then I'm going to make it yellow. That way I don't miss it. And then I'm going to make it more bigger, more better, baby. For those of you who ask why I speak in wrong English, I had a coach in high school. So I played football. I did powerlifting. I did discus. And I had a coach, and it was so funny to me because he would always say things like more better, more bigger, things like that. Like intentionally knowing he's saying it wrong. And it was hilarious. So that's why I do it. So yeah, come at me all you want. I've been speaking English for 39 years. I know the proper way to say it, but I like to do it my own way. I think it's more better. There you go. Okay. Anyway, we're going to name extrinsic value as, rename extrinsic value as uncertainty value. I know I didn't spell it right. I don't really care. This is just a note for me to go to later. Rename extrinsic value as uncertainty value, uncertainty premium. That right. I don't like premium. People are going to say, oh, why not just sell premium then? We don't sell options around here because we like to make money and not lose money. Okay, rename extrinsic value as uncertainty value, because that is what we're paying for here. We want to minimize the amount of uncertainty value. Okay, so I'm gonna drop that on there. You'll see it later on. I love doing this live, by the way. It's so much better than a recorded video.
Just because it only has $36.41 of intrinsic value right now, there's the potential that the option will have significantly more intrinsic value in the future if Tesla shares increase by a significant amount, which is certainly possible considering that Tesla shares can move around hundreds of dollars in just a few days' time. So that explains why this option has a lot of extrinsic value or time value in its price. The current real value or intrinsic value of this call option is only $36.41 right now, but it has almost $60 of extrinsic value or time value, because with over 30 days left until this option expires, there is plenty of time left for Tesla to make a big upside movement, and that would leave this call option with significantly more intrinsic value. So you can think of an option's extrinsic value as the time value or the potential,
the uncertainty value,
for that option to become significantly more valuable through share price movements between now and expiration. Now this brings us to a very important point about extrinsic value or time value. Options with more time until expiration will trade with significantly more extrinsic or time value compared to the same exact option with less time until expiration.
We just talked about that a moment ago, but let's demonstrate it here real quick, right? Let's look at so market's live right now. Let's do at the money. This will be easier, right? So let's go 2 days out, the 335s, and let's do the 330 because I just saw that one back there. The 330 with 2 days out has $6 of extrinsic value. The $3 with the 300 or 330, daggum, hang on. stumbling over my words here. All right, so this has $6 at the 330. If we go now, let's pull up a spreadsheet. That'll make this easier. Hold tight real quick while Excel loads. Blank workbook, please. Thank you. All right. So we have 6/13, June 13th, with 2 days to expiration. We're looking at the 330 strike. That will give us the extrinsic value of $6.30. Okay. Now let's go 22 days out, July 3rd, 7/3. This has 22 days out, the 330 again. The extrinsic value is $20. Okay. Now let's go out 44 days to July 25th. Let's do the 330 again. This has 44 days to expiration. The 330 gives us a value on extrinsic of $29.94. As you can see, it grows because there's more uncertainty. The exact same option with longer duration will always flatline right there. Always, because it's math, always have greater greater uncertainty. We know this. And because it has greater uncertainty, it has greater extrinsic value. Look at that. We're learning something together. We're learning something together.
And what I mean by that is if we look at two call options with the same strike price and we look at two different expirations, the call option that has a further expiration date will be trading with significantly more extrinsic value.
Well, this is good. This is good, Skinny Buff Guy. I love it. I would love to see a meme on that, but that's really good. The uncertainty value. Look at us. We're changing financial terms over here.
Because there's lots more time left for the stock price to move and therefore cause the option to become significantly more valuable, particularly intrinsically valuable. Now, the IWM put that we looked at earlier, it should make complete sense why the put option was worth $624 when the strike price of the put was $130, but the price of IWM shares at that moment were actually above $130. The reason that the put option was worth $624 is because it had over 30 days to expiration, and in a 30-day time period, especially right now during the coronavirus pandemic and the market volatility.
Oh my gosh. Okay, to go way off topic here real quick. I don't know if y'all watch Joe Rogan, but you should. There is a new video out. I've been listening to it this morning on the way to the gym. Hang on. Joe Rogan. Go watch this one with Dr. Mary Talley Bowden. I'm from Texas. It's Bowden. Holy moly. It's like, if you want to know some shit that went down during COVID, go watch this. I was flabbergasted. But anyway, in the midst of all this COVIDness is when this was happening. Back to reality here. Looking at this put right here at the money put, actually slightly out of the money put, is full of extrinsic value. It's all extrinsic value. And because of that, it is all completely full of uncertainty value. Okay. That is what we're looking at right here. When it's all extrinsic, zero intrinsic, it's all uncertainty value.
That we're seeing, there is certainly a good possibility that IWM falls significantly. And for that reason, that 130 put option would become significantly intrinsically valuable. And that's exactly what we saw happen. So the reason that the put option was valuable, even though it did not have any intrinsic value, is because it still had lots of time left. And since the strike price was close to the stock price, any downside movement in the stock price would leave the option intrinsically valuable, which, as we know, is exactly what happened. So if an option doesn't have any intrinsic value, it doesn't mean that the option isn't worth anything, because if it has lots of time left until expiration, then there's still lots of time left for the stock price to move, and that could leave the option with intrinsic value or real value. But as we saw in our losing call option and put option examples, if an option does not have any intrinsic value, but also does not have a lot of time until it expires, then there is very little time for that stock price to move, and therefore there's very little time for that option to actually become intrinsically valuable. Now,
very little time equals very little uncertainty equals very little extrinsic value. Look at that. We learned a lot on this. I believe this is going to wrap. Yeah, that's going to wrap this section here. I really am enjoying going section by section through this. I hope that this is valuable to you, because this 3-hour long video covers a ton, but it's great to hear real world perspective and give a little commentary on this. So great video by Chris Butler. I've actually had the chance to interview him once on my channel, but we're going to make this even more better. Look at that, even more better. He was talking about. Let's go through your questions here. Shane asked, good morning, Chris. I've been doing a deep dive into simple moving averages versus exponential moving averages. Can you explain the difference you saw in the two and why when you chose your style of trading? So early on in my career, I connected with Steve Burns. Steve Burns has been the biggest mentor ever for me. And exponential moving average is where I got, from Steve Burns is where I got exponential moving averages. They move faster than simple moving averages. So let me clear my charts real quick, and I'll show you the difference in a simple and an exponential. Okay, everything's turned off. Let's add simple moving average. Simple moving average. Oh, good gravy. I don't know what that was. I just want a simple moving average. Give me a regular simple moving average. Okay, here's the deal. I like TradingView, but it can be absolutely overwhelming. This is frustrating. All I want is a simple moving average. Moving average. Simple. Goodness, that's so stupid. Why do I have to go through all that work? Okay, simple moving average. That's all I want. Let's remove this. Simple moving average. Oh, I just turned it off. Let's do a 20 period. And we'll make this yellow or orange. I'll make it thick because I like them thick. There we go. Boom. And then we'll add the 20 period EMA with the black line. So the EMA is the black line. The SMA is the orange line right there. You can see they measure the exact same thing as far as dates, 20 periods of average values. But one of them is moving faster than the other. And it's because it puts more emphasis on the current values, right? You can see right here, the average price, simple moving average, peaks and comes back down, where the exponential moving average peaks and comes back down days before the simple one. That's the reason I use them, right? Here's another example. The 20 changes direction days before the simple moving average changes direction. Great question. Antonio, we understand that the market trend is most crucial of the 9 itty bitty baby steps. Oh, you mean the outlier 9? You mean the outlier 9 being the 9 itty bitty baby steps for the slingshot setup? Exactly right. The market trend is the most crucial, hands down, absolutely. But is there one you'd say might be the least important? Ooh. Well, if I had to, honestly, if I had to tell you what the least important was, and I hear what you're saying right now, that the market still has a sell signal, I would not put that as the least important. No way. If anything, I would probably say, I don't know, they're all important, right? I would not trade without any one of these. So I want all of them. So I don't know, dude. You do you in your plan, but I would not go against the market signal. That's just me though. If there's sufficient liquidity when buying a call option, would you be confident of enough liquidity in the future when selling? Oh yeah, for sure. For sure. If you can get in, you'll most likely be able to get out because that's where people want to trade at. I've never run into a case where I had a hard time getting out if I had an easy time getting in. But if you have a hard time getting in, you will have a hard time getting out for sure. Jock, what's up, dude? Can you explain why Amazon didn't show up in the screener on its buy signal yesterday? Trying to fiddle around with the screener, setting things, but I can't make it show up. Let's go take a look. See if OVTLYR is working. I know it was down a little bit ago. Okay, it's working right now. Great. Let's go to Amazon. First, I need to go into any stock, and then I need to type Amazon. So depending on your screener settings, it'll show up or not, right? Now, I don't know your screener settings, so that's going to be a little bit hard to see, but Like, for example, if you had your screener settings and you didn't want to see anything where the fear and greed was over 50, that's why it wouldn't be there. Or if you didn't have the green overlay selected, it might not be there, right? I don't know what you put on your screener settings yesterday. I'll show you my screener settings. It's going to be hard for me to replicate that, by the way. But these are my screener settings here. Feel free to take a screenshot once this loads. Feel free to take a screenshot and then go to town on it. But yeah, I don't know why it wouldn't have shown up for you yesterday. Let's go to the next question from CMAC. Can you elaborate on your intraday emergency exits from yesterday? Oh, yeah, for sure. So in OVTLYR University, wait a minute. Did somebody get me to plug OVTLYR University?
Are you ready? Let's go!
Respect is earned. Respect is never given.
So OVTLYR University is our absolutely 100% free trading course where I'm teaching you every single thing that I know about trading here on YouTube. We have our first alpha group going through right now, and we're trying to improve it as we go. We're going to be doing this forever, just so you know. That is the plan. And we're going to be taking more and more people who can join us in class live, and then everybody else can watch it for free here on the YouTube. And it is so cool to be able to teach you every single thing that I know. Now, here's the deal. We're going to have probably 3 groups of people. Half of the people are going to listen to it passively and not learn anything, go through one ear and out the other, and it's not going to change their lives at all. 1/4 of the people are going to listen to it. They're going to misconstrue everything that I say, and they are going to lose money, and they're going to blame it on me, saying, Chris, this is all your fault. This is your fault because you made me lose money. Impossible for me to make you lose money. Those are your choices because I'm giving you every single thing that you need for you to figure it out. You know what? I shouldn't say impossible because every trade is a unique instance, right? Now, you need to keep that in mind as you're trading as well, that you're going to have losers. You're going to have losers. They're not all going to be winners. But on the whole, if you figure out a plan that works for you and you can implement that plan and not be emotional about it, and we talked about earlier how you can mathematically prove that even in the worst case scenario, you're still going to be profitable, it'll be great. But there's going to be 25% of people who absolutely don't know what they're doing, and they're going to say it's my fault they lost money. But then there's going to be 25% of people, and you can decide to be in that top 25% who actually listen, implement, learn, ask questions, execute, and are profitable and change your life, your family's life, your children's life, and all generations to come because you finally figured out the way to be profitable in trading. You get to decide where you lie on that spectrum. Of course, you decide, not me. You decide if you're going to listen, if you're going to take the lessons from OVTLYR University and change your life, or if you're just going to listen. So you do you, right? Now, that was one of the lessons in OVTLYR University yesterday. So let's go look at the emergency exits that I was sharing in my trading plan. So number 1, if the price moves past the planned exit point at the close. So let's look at a stock. Let's look at Tesla. It really doesn't matter what stock, where or when, but if a stock closes below my planned exit point, let's see if I can find an example. Let's go with this one here. This candle right here. This one right here. Let's say that I'm going to get out if it closes below this point here at 242.50. Okay. But when I'm looking to make my trading plan, and let's say I'm looking at 2:30 Central Time, and it's fine. Let's say it's trading somewhere up here around 243. Okay. Let's say I have a position up here at 243. No big deal. But by the end of the day, it actually goes down and ends up somewhere down here, right? So it goes through my planned exit point. Planned exit point can be your trailing stop, your stop loss, whatever the case is. That's why I call it a planned exit point. I don't know what it's going to be, but it's going to be a planned exit point. It goes from here all the way down through here by the end of the day. The last 30 minutes, I completely missed it. Oh man, that sucks, right? Is what it is though. I then set an alert the next day on the low of that candle. If price breaks through the low of that candle, that is a intraday emergency exit for me. Could it go up? Yeah, for sure. If it goes back up, we go back to plan. But if it goes through the low of this exit, that is an emergency exit midday. Something ain't going right, and I'm going to get out of here. And that will keep you out of a situation like this, where it just like screams down even further, right? Screams down even further. That's one of my emergency exits. The other emergency exit is when it runs up into an order block. So imagine, let's just draw a block right here. Imagine that it runs up into this order block right here. We don't know if it's going to continue on or if it's going to hit that order block and get rejected. So I switch to the 5-minute chart and I use the 10 and 20 EMAs. If the 10 crosses under the 20 EMA, that is an emergency exit midday as it hits the order block and bounces back down. If the 10 and 20 do not cross at all during the day, I'll hold it all day. That's fine. But when they cross back down, Chris is out. But I will close at the end of that day because I don't know if it's going to get rejected or continue on. And being inside of an order block presents a lot more risk than I'm willing to take. So great question, CMAC. Appreciate you, my friend. Theo, Jensen at CTG in Paris, I don't even know what that is, said a couple of good words for quantum stocks in the pre-market all jumped. Should we look at them for a quick profit? You do you. Follow your trading plan. But if my trading plan had anything to do with outside forces like whoever Jensen is, I feel like that's a really risky trading plan. No, thank you. You do you, though. Steve, I can't believe we get all this for just 82 cents a day, right? Well, you can't be serious, right? That you can get, that you can start saving time, making money, and start winning with less risk with just 3 easy steps by going to OVTLYR.com and picking up the annual pass for just 82 cents a day. Oh, I missed that slide. There we go. Pick up the annual pass for just 82 cents a day, or if you're on the monthly plan, upgrade with 1 click and then sit back and relax because you just found the easiest way to save time, make money, and start winning with less risk. Man, I can't believe that either, Steve. You're awesome. Steve has another question. Are options chains different for paper trading or the same as live trading? I've been struggling to trade. Is there very little open interest? Oh, I don't know. That's a new one on me. It should represent exactly what's going on with the market. Rick asks, does it matter that the 1, 2, 3, 4 has an outlier block or only follow daily charts or outlier blocks? So Rick, the way that I look at things is I have a time frame, which is on the daily time frame. If it's happening in the daily time frame, I'm interested. I care about it. If it's happening in the weekly time frame, that's bigger than I look at. I don't care. If it's happening on the hourly time frame, that's smaller than I look at. I don't care. Match your trading style to your time frame, whatever that is. And if it's the 2 hours, run with the 2 hours. But I wouldn't be going deeper or further out to make my decisions when I can focus in on one time frame, because you're always going to find noise no matter what, either direction. Joe says, on my favorites list, show that real quick. Where'd it go? Dashboard. And then you can just go to the watch list here and it'll show your favorites. Joe, by the way, I'm going to send you an email just a little bit. What I see right here, right? Do I look at the Dow or the Qs for anything? No, I just add them there. I just think it's interesting. I mean, you can add whatever you want on that. So listen, I need to run. I really appreciate hanging out with you guys. We can learn so much in the options trading videos like this. But if you want to save time, make money, and start winning with less risk, you should probably click on one of these 2 videos. Have a great day. We'll talk soon.